there's 2 to 3 weeks worth of, lost work time, maybe 4 weeks. And so everyone was busy before, and now they're more busy than ever. It's all schedules are being broken, all, timelines are screwing up. And I'm sure for any clients that need work done before a closing, it's just, you can't expect it's going to happen. It's just too much.
Did you have a lot of people out?
Yeah. I mean, I'd seen all the patterns and everything was going great under COVID. And then right around Thanksgiving, you started going, uh-oh, this is going to be different. And certainly it was.
It came on fast.
It came on fast, and we just saw it's very quickly. You hadn't heard of anyone getting COVID, or you hear about it once a week or something. And all of a sudden you're getting 3 or 4 a day, and then you're getting 7 or 8 a day, and then you're getting 20 a day, and then you get it. And it's like, oh, well, no, luckily I was entirely asymptomatic, so it didn't really matter, or 99%. So didn't really affect me a lot.
So you said you were super busy, and yet when we talked, you weren't necessarily hiring. And so can you talk about that?
Well, I mean, we've got like 125 employees, but the reality is on any given day, we probably have a couple thousand people working on our jobs. So most of our people are vendors and subcontractors. We just handle the management side, both inside and outside. And so, I mean, we're actively hiring just in different spots, and we're looking for people, but we're not desperate. We have a good solid crew right now. We're talking to folks, and sure enough, each time you turn around, somebody's going to go off and try something different. And there's a constant turn under employees, and we have guys who are retiring. And whenever a good person comes up, we certainly want to interview them, know who they are. And even if we don't hire them right then, we're ready to go for sometime in the future if the opportunity does come up.
Well, so I'm going to pose the question differently, and it's one I'm going to ask my guest, which is the current euphoria and strength in the market, are you anticipating that we're going to see several years of this, and you're calculating that into your business, or is this just a momentary phase?
No, I think we've got at least several years. I mean, real estate drives construction. In the residential world, real estate transactions drives construction. And as you guys all know, it's been very busy on your end. And so people change locations, they move, they realize they need to do some work, they want to improve it, make it into their own place. They bought it because they were going to tear it down and do something new. And people, again, you can make do in a short term, but over a longer period, people really want to make those changes, and housing stock depreciates and ages, and it has to be brought up to code, has to be repaired, and then it also has to be brought up to taste.
But you're anticipating several years of a bull market, and yet you're saying you're not necessarily hiring, or you would hire if the people were available.
We operate in a couple different markets: Northern New Jersey, New York City, Hamptons, and then Westchester, the Fairchester area. And in Fairchester, we don't necessarily want to be bigger than we are. In the Hamptons, we're always on the lookout for good people and finding the right folks, and we would take additional folks. New York City, again, I mean, at this point, we're actively looking, but we're not. It's not like we're trying to double our workforce or even go up by 20%. We can use some additional people, and when they come along, we'll take them. But we're not actively trying to double in size or anything. We prefer to go for better jobs at better margins than trying to drive top line growth.
It was Roberto. I guess I lost his camera. There he is. He's on the phone. John Berman, fabulous designer of fabulous apartments and houses. Just joined the call. Excellent. All right, so I'm going to continue to ask Scott Hobbs about the economy until we get our featured guest. In Roberto's most recent, in Roberto's most recent market report, he talks about inventory and interest rates driving this market. Do you care to comment on that? Because I'm going to take issue with him when he gets off the phone on inventory and interest rates being the defining factors for 2022. What do you think?
Well, I liked Roberto's letter. I think it's always informative. Just trying to kiss up to him a little bit, but It's no, I mean, I think the interest rates play a key role, but hopefully, in addition to the interest rate, you also have, I think what drives the consumer is are they doing well? And so if the buyers are doing well, plus or minus, 50 basis points or 100 basis points may not matter, especially in a low inventory market. At some point in the interest rates really do matter. And again, at the very top level of things, people are paying cash and the interest rates don't matter as much. As we get down toward, mere mortals, like the vast majority of people, the interest rates do matter. And if you're leveraged up to the hilt, you can't go any further. However, even if you're leveraged and all of a sudden, you're getting a 10 or a 15% pay raise, which I know are still hard to get. But if you're getting a big bonus and a good pay raise and you're able to keep moving and you need a house, you're probably willing to dig deeper a little bit to keep things moving. And at the very top end, I think the interest rates are much less important. Many clients end up, again, they're buying essentially with cash. They may finance it, but they're essentially buying with cash.
I'm going to argue that the difference between a 3% interest rate and a 4% interest rate is not what is driving our market. And I believe that I think it has a whole lot to do with demand.
You didn't read my December newsletter.
Okay.
The December newsletter said that 2022, it was the feast of 2022, and it was a feast from a demand perspective. The demand would be overwhelmingly strong. So building on that, interest rates and inventory will be the key factors. And interest rates not yet, but they will. Second half of the year, people are not going to be able to afford what they could afford before. They're not going to be able to get the money that they can get, but also for sellers too. Sellers have to realize that affects them as well. As a buyer, I'm a buyer. I can't offer you what I could have offered you when the interest rates were lower. So I think that's going to play a big role later, not for the all cash, not the uber luxury like Scott had said, but I think for a big sector of the market, it's going to have an effect. And inventory, I expect inventory to be ample, but will it be enough to satisfy the demand?
I think it has everything to do with demographics. And I think it has everything to do with the fact that there are more people entering the market. And I actually would put interest rates in fourth or fifth or sixth most important factor. When you talk to people who lived through the last few crises and paid 16% interest rate on their first home, when you ask them, why did you pay, Mom?
When was that?
Mom, why did you pay 16%?
1982.
That was 1979.
Yeah, okay. I mean, that's a different era.
People say that was the interest rate, so I paid it. I didn't have a choice. I had to live somewhere. I had to move from the suburbs to the city or the city to the suburbs. People don't have a choice. It may dictate which house they buy. It may dictate affordability, but it doesn't dictate whether they're entering the market. When grandma dies and leaves her home, it comes onto the market. And when the couple gets married and wants to buy a home, they're in the market. The last thing they look at is interest rates to affect their time. They may try and time the market a bit. They may delay their decision a few months or a year, but I think that only changes the elasticity of the decision. I don't think it, and which house you buy.
But the interest rate affects the level of the water. Are you in shallow water or are you in deep water? And that becomes about affordability, but that's an interest rate metric.
Roberto, let me ask you a question. What do you expect interest rates to be at the end of 2022?
I think they're going to be close to 4. And my question goes.
So let me tell you a quick story.
Yeah.
In 1958, my father and mother had the lowest possible interest rate because my father was a veteran and he had a VA mortgage. Take a guess at what the interest rate in December of 1958 on the lowest possible rate was.
I have no idea.
4.78%. Inflation adjusted, the bank is paying you to borrow money today. Psychologically, the fact is that for the last 15 or so years, we've had artificially low interest rates. And psychologically, it will absolutely have an impact on people, because people will remember that they could have gotten 2 7/8, and now they have to pay you 3 7/8, and they don't like it. Economically, though, John is right. Economically, it will have a minimal impact economically, because at the end of the day, on $1 million, the difference of a point is going to cost somebody about $12,000 a year. Okay, they can afford it. They don't want to pay it.
But it's all about perception. I've worked with buyers for 22 or 23 years.
I'm not arguing with you. What I'm saying to you is that it's not an economic. It is going to be
I don't disagree with
an emotional.
There's some economics,
decision.
but it's a bigger emotional decision. But it's the emotion. This is a home. 90% of the people who live in New York are users of their apartments.
Do you realize that many of these people who are moving are going to be on a staggered remote schedule? They're not going to be paying as much for lunch. They're not going to be paying as much for transportation. They're not going to be paying as much for dry cleaning. They're not going to be paying as much. It is not an economic decision. It is up to us. Okay. And up to sellers as to what they're going to do about pricing. Other than certain marketplaces, okay, which obviously have done incredibly well, but the Manhattan marketplace has not gone through the roof in terms of valuation in the last 12 months. Okay.
No.
I mean, so at the end of the day, there's, psychologically, it is going to play a factor. Economically, I don't believe it's going to play as large a factor. Okay, so when people get comfortable with the fact that their mortgage payment is going to be a little bit more, they'll get comfortable with it. Will they all get comfortable with it? If you're right about the inventory situation, which I don't think you're wrong about, if half of our buyers dropped out of the market tomorrow, we'd still not have enough homes. So at the end of the day, it's the demand factor will negate
with one another.
The cost factor.
But the two factors working, interest rates and inventory, I'm telling you, it's a huge psychological factor, and that is a bigger factor than I think. It's a bigger component than and unquantifiable that you're not considering.
So let me pose it to you a different way. Just reflecting on your last 10 buyers or your last 20 buyers, and they're thinking about buying an apartment in New York or out in the Hamptons, and they're deciding to time the market. Is it a greater influence, the lack of inventory, or is it a greater influence, interest rate changes? So if they believe interest rates are rising, there is
an easy answer. It's an easy answer. Interest rates have not been an issue for years, so it's not even been a part of the conversation.
Well, let me pose it to you this way. On the one hand, it's a profound sense of urgency. I want to buy now because interest rates are rising. But if I buy now, I feel that I am competing for a property with so many other buyers that I may overpay. So you have two different and opposite tendencies. I think I'll wait, but interest rates will harm me. But if I wait, I might get a better deal in the market. And I think what you're seeing is people are saying, interest rates don't matter. If I can find inventory, I'm going to bid on it. And
I think that regardless of, this is what I think. You want to buy now because in 2, 3, 4 years, the market will have will have appreciated, and it will be more expensive to buy then than it is now. Now, interest rates, I still think that even if interest rates rise, I think that will continue to happen. They'll both rise. The question is, and I don't think it's going to happen, but I wanted to ask Kent this specifically. Is there any plausibility or any scenario that you see where interest rates go to 5 or 6? And if that happens, what is the effect? Because that is a big change.
We're negating a very important part of this conversation. And the other I word didn't come into the conversation, and the other I word has to come into the conversation. The other I word is inflation, because hard assets do incredibly well during inflationary times. Okay, hard assets meaning precious metals, meaning real estate. Okay, so if the inflationary spiral continues, I was going to say if we're in an inflationary time, we are in an inflationary time, that is for sure. Whether the inflationary spiral continues or not, you talked about property being worth more 2, 3, 4 years down the road. It will be worth significantly more if the inflationary spiral continues to hit. So that may force people. And if the inflationary spiral continues to hit, we're going to see real big spikes in interest, because we're going to see the Volcker rule. Okay, the Volcker rule was 18% interest rates to kill inflation. Okay, that's what Paul Volcker did. Okay, that's why we had 18, 19% interest rates, because he had to slow down the economy. And we'll see. And if that's the case, there will be no other choice but to bump interest rates as fast as you possibly can, to as high as you have to crush the. And you're forgetting another thing, forgetting about the amount of money that's out there today, the money supply. I mean, the government has flooded, and this is not a political statement. They had no choice. Okay. They had no choice. I mean, the economy was shut down for 5 months. I mean, people had no money, but we flooded the economy with a ton of money. I mean, people are sitting on lots of money, along with the fact that the stock market has done incredibly well. And that's why you can have bonuses larger than you've seen. That's why rents in Manhattan are back to pre-pandemic times. There's a lot of money out there.
Are there other tools to slow the economy? I mean, interest rates are
There's no other way to get money out of the
pedal,
economy. There's no other way to get money out of the economy other than to get rid of the debt. There's no other way that I know of. That's a great Heym question. But as far as I know, the only way to stop an economy from too many people chasing too few goods is to jump interest rates. It's the only way I know. I can't tell you that I'm 100% right.
Well, Roberto, the other thing that actually, I'm not sure how it depending on the market, but regulation's the other way to slow the market. And I think there's a huge, there's actually a conflict going on right now inside of most zoning issues, that people are really pushing for affordable housing. They're trying to push affordable housing, accessory dwelling units, and some stuff that actually it'd be nice, but that's handling a very tiny, tiny section of the market. And it's really kind of government sponsored and subsidized housing. Whereas on the private side, it seems like the government's doing everything they can to go ahead and just layer on more and more burdens and taxes and fees and other stuff on private development, which means that whatever exists today, it's harder to build it and harder to do replacement. So I would say that the regulatory side actually is advantageous for the existing market and the existing sales, because they're just not letting you build as many as you'd like in our markets. And
with what Scott just said, it also then adds additional costs onto the consumer, which is inflationary. So you got a circle that doesn't stop, because the regulatory fees means that, somebody's got to eat it. Okay, so usually it's going to be passed on to the consumer, which drives up prices, which makes things more inflationary. So it's that vicious cycle.
Yeah.
Do either of you New Yorkers want to comment on regulation and the Eric Adams administration coming in now? Are we going to see a period of deregulation, or has he signaled that he's going to be putting gas on the fire? I mean, have we seen any signals as to what the New York economy is going to be like under Eric Adams?
That's
He's gonna
exactly
take
what I
his
was gonna
pay in
say.
crypto. I mean,
That's exactly what I was going to ask Kent. That precisely, because he's been very vocal about regulation. Sometimes he's actually very for it, and sometimes he's not, depending upon what the circumstance is. So I was really curious to ask him what.
He's a big Eric Adams fan.
So
in
it
his
was-
last few articles. So yeah, that's a good question to ask him. But I just wondered whether, I don't know, that you guys in New York are optimistic about the New York economy because of the change in administration.
I'm optimistic of the New York economy primarily because of the people that are investing in the city. I mean, the tech sector, the amount of money that's being poured into the city, people who are buying big luxury apartments, they're buying those apartments to live here. They're not buying those apartments to rent them. And those are smart people who are putting their money right here. So I believe in that.
Are they second homes or are they primary? Are they coming here because there's a job market for them in New York, or are they coming here with their second home purchase?
I think it's a little bit of both. I think there's second home, primary home, and co-primary residence home. You know what I mean? A house in Connecticut, house here. House in the Hamptons, house here. House in Palm Beach, house here. Half the time.
the economy in New York won't be governed by government action. The economy in New York will be governed by when the virus is under control and tourism comes back and restaurants come back and people go back into their offices and the local luncheonettes are open. And that's what's going to open up the economy. Nothing in New York has changed other than the virus. Okay. You know, I mean, I love when people talk about the crime rate in Manhattan. Okay, take a look at the crime rate in Boise, Idaho. Okay, the fact of the matter is that we've had a time period where people have had too much time on their hands. When mental instability is a real problem in this country. Okay, and every place the crime rate is going up. I mean, New York's going to be fine once the virus is under control. Europe will start to travel again. Hotels will start to be open again. People will go back to their offices. The subways will be crowded again. The streets are, I mean, I came from the airport this morning. Traffic was a real bear. Okay. So, it's not going to be and I'm not saying that government doesn't have some play in this, but the economy, a government can't turn up an economy and can't turn down an economy. Government gets too much damn blame and too much damn credit when things are good, and when things are bad. You know, absolutely what Scott said about regulation and all of that has a play in it. Okay. But regulation regulation under Barack Obama wasn't a joy, and the economy did pretty damn well. So
I haven't heard anybody say anything about employment. I tried to bait Scott Hobbs into saying that behind his optimism, he was going to be hiring every good person he could find, but he said not necessarily. And even though he believes in a several years of bull market. So how do you support this fabulous New York economy and this fabulous New York and suburban real estate market if you're not hiring, and if you could, you can't find the people?
Well, I think that just ends up delaying some of that growth, which is, again, not necessarily a bad thing. I mean, you have instant gratification versus slightly longer term gratification. And if someone's able to double their business, it creates a whole nother series of problems and issues for them. The fact that you only would be growing by something at 10% or 20% is not necessarily a bad thing. That being said, I mean, if you can build I think if there's a good story that's building where people feel confident that they have a job, they're able to change jobs if something were to happen to their job, they have opportunity to do something else. I think that's all very bullish toward real estate, because then people are confident that, if they don't feel like if I lose this job, then I've got to go ahead and sell my house and move and rent and downsize. I think in this environment, people are like, well, if I lose this job, I can probably find something else, and who knows, I may even get a kicker on it. So I think that that ends up being something that is beneficial toward the market, and so, well, and also leads to some of the inflationary pressures. But for keeping the market strong and people looking, I think that's very beneficial.
John, you're also neglecting to remember about business formations. The business formation in this country over the last 2 years has been the fastest than it's ever been. There are more people who have left their job are now starting their own businesses. So they're not looking for, so it's gonna, the idea of the way that we looked at employees is changing. And a lot of people who had jobs, working for companies are now starting their own jobs. And Scott Scott also said he's looking for contract workers. It's not so much that he's not looking for people. He may not put them on payroll, but he'll hire a subcontractor. So it's a little bit more broad than just the employment factor. It's also a business formation situation.
Tony Fox. I want to introduce you to the room. Tony Fox is a recent graduate, 25 years old, I believe, recent graduate of Fordham, Division I athlete, knows how to compete, knows how to mix it up in the market, and is beginning his career as a real estate investor and real estate developer. And so he came intending to ask Kent some questions. So can you talk about your decision and that of your peers coming out of Fordham and coming out of college into the market now, and the tendency to start your own business versus the tendency to get trained by an established business?
Sure. So thank you for the opportunity. First off, definitely excited to be here with all of you. So being at Fordham University, being in the heart of the Bronx, taking classes down at the Lincoln Center, I'm fortunate enough to be exposed to an abundance of entrepreneurs, very progressive, forward-thinking individuals. Fordham has a great, list of professors that I heavily relied on as well. But really, once I graduated, and there was a span of a few months where, I was unemployed. I studied engineering physics, a very tough degree, while playing football. So I know the numbers, and I ran the numbers for real estate, and I was able to see from, whether it's a duplex or 100 units, the scalability, so scaling was a huge factor for me, and being able to build, one, a sustainable business, two, make an impact directly in a community and over individuals' lives is very important for me. I'm an avid volunteer. I sit on 3 nonprofit boards, so love to give back. And to me, there's no better way than, giving someone a decent place to live. I've been through house fires myself, so I have the motivation and the personal background to really, I believe, make a true impact in
If you're going to start your own business instead of at 25 joining a big firm and getting trained and I just want to understand, as Michael Goldenberg just pointed out, you are part of a trend of millennials starting their own business at a rate we have not seen in decades. And I think part of it has got to be that you're looking at the alternative and how much assurance do these big firms give you? How much security do they give you versus the opportunities in the market right now? Are you that optimistic about the market right now and your opportunities to start your own business in it, especially in the real estate business?
I am. I think it goes back, one of the points that Michael said earlier, inflation. Real estate is one of those hard assets that you can really carry over time. For myself, I actually was outbid on a couple properties this past summer and over the last year. So what I did was I took advantage of the marketplace and, purchased a primary condo for myself. So now I live in a, good area, very happy. But, my goal is to really get back out on the market, look for a commercial property, mixed use space. So I really do believe that, everything you said about the vicious cycle, I see it, as far as someone has to eat the cost. And I rather, I don't want to say eat the cost in a negative sense, but someone has to be responsible for, paying a mortgage, So I would like to be that owner of a building that will rise over time with appreciation, having my tenants, being able to justify raising rents in order to, offset that cost.
How is it
Well-
now in the market to try and raise money, either borrow or raise through investment? Or if you're 25 and you don't have a great long track record, of credit worthiness.
Correct. So right now, it's friends and family. I do have some money raised actually for a venture I'm trying to launch during Q2 of this year. Choosing Q2 because starting off small, I want to give myself the right amount of time for due diligence, prep work, speak with various individuals, just so I'm a firm believer in not letting my lack of experience stop me from pursuing real estate and from buying $1 million property if I have the ability to. So I really think it's people believing in myself. Like I said, I sit on 3 boards, so from a strategy standpoint, it's not foreign to me. Optimizing a business, optimizing cash flow. I've been doing that 25. I've been doing that since I was 22 years old when I joined my first board. So I really do believe that with the right structure and the foundation, that will set me up for future success. And and allows people to be comfortable in my vision for real estate. Most of my friends and family that I have received funds from, they are well aware of the potentials of real estate, using it as an alternative investment, not only to the stock market, but in terms of diversifying their portfolio. They're willing to put 25% into real estate. So I would like to capture that if I can.
Clearly, Roberto, Michael, Scott, clearly there is an optimism among millennials that real estate is a rising asset class. They're buying their own condos and they want to, but generally speaking, they want to invest in real estate. I think it's interesting to me that you said mixed use real estate. You're not focused on, a lot of the headlines have been wrapped up in the shortage, a 5 million unit shortage of residential real estate across the nation. We've dug ourselves into this hole over a decade of underproducing residential real estate. And yet a lot has also been made of the fact that retail has been in trouble for years. A lot of retail has been shifting to online retail. And a lot of retail in the New York City market right now isn't back to pre-pandemic levels. Does anybody want to talk about the different sectors of real estate? Because I think we spend a lot of time talking about residential and how it's on fire because we're realtors and we like to talk about the positive story, but the commercial has not necessarily been all positive.
I think the retail's coming back a little bit, but I think and supposedly the class A type buildings, because they're big companies typically that occupy those, they're companies that are upgrading into those spaces, and that where there's going to be a gap, or the B, C buildings where they're typically have smaller occupants and smaller businesses, they're going to struggle to get tenancy, and they're going to have to hopefully look to the city to allow them potentially to change the usage of those buildings, because they may not survive. Their best use or their prior use may not allow them to survive. Someone even suggested that a couple of those buildings could go into bankruptcy and they could be just sitting vacant. which could change the dynamic of the city on certain streets, like in Midtown and things like that. However, that's yet to be determined, and we'll see. But
that's consistent with anyone else jump in as well. But that's consistent with some of the Kent Swig's interviews with Bloomberg and others lately. He said he sees the Class A office space doing just fine. B and C class may suffer. And he also talked about, and I want to hear your opinions on this, but a lot of the big box retailers are going to go away, and they're going to get replaced with a more European model of smaller retailers occupying those spaces, which, to your point, Roberto, may require rezoning and reconfiguring and redevelopment of a lot of these buildings.
that would be great, because it would make the city a lot more accessible. It would allow so many more people to, run their small businesses and have their, their ice cream shop and their leather goods place and things like that. However, the rents will have to adjust. There's going to have to be a recalibration of that in order for them to survive.
Tony, you sure you want to buy a building with rents, with commercial rents going down, needing still to adjust?
Correct. So the question I was going to ask is, we talked a little bit about regulation. So here in Connecticut, where I'm based out of, in the past, I'll say 2-3 years, even, pre-pandemic times, I've seen an influx of larger corporations trying to get down into the Stamford area, trying to break into the Hartford County markets, leasing out, entire floors or buildings, just because Connecticut is promoting, tax advantages for such businesses and for those building owners. Do you guys have any comments on that, or any experience dealing with, taxes and, economic development within counties?
Michael's a tax guru, maybe.
Unmuted.
Sorry, can you repeat that?
Go ahead.
Yeah, so my question was, how much of a factor does regulation and individual county economic development play on, new companies leasing out buildings for tax advantages, or, a landlord discounting rents? If you have any experience with that at all.
I don't have personal experience with it, but my gut, and Greg Heym is on this call. I noticed that he jumped on, so he might have some real good insight into that. What I can tell you is this, that during the Trump presidency, he instituted opportunity zones. Okay, and those are tax advantaged situations, and that absolutely helped to develop. Okay, or help well, it didn't help as much as it was meant to, but that wasn't anybody's fault other than investors' faults. They played the angles a little bit. Okay, it wasn't meant for that purpose. But those type of things are absolutely beneficial to areas appreciating, areas getting more businesses, and more buildings being renovated or constructed even. For that type of thing. But regulation has an impact on, look, when building permits go up, and when license fees go up, and when sanitation costs go up, it becomes more difficult for a small business person to be able to afford it, and especially one who's just opening up.
Sure. Now,
so it's got to have some impact.
I'm going to answer that question, but briefly.
Please.
I believe, and you can tell me I'm wrong, Michael, but I believe that deregulation has an impact on the margins. I believe that if you deregulate and you change the tax policy, it may encourage somebody who's on the fence, on the margin, to invest in Bridgeport, invest in the Bronx, invest, basically move out of the Manhattan market and invest in an apartment building in Queens. But I think it only encourages somebody who might already be moving in that direction. Deregulation and tax policy is not enough to drive the Bridgeport market. to turn a market around. I mean, I think it only, it's the icing, it's the icing on top. Agree, Michael?
I think you're right. Yeah,
And it's not just in challenged areas, even in some of our most affluent towns, I have seen builders, guys like Scott Hobbs, come in and say, I'm not betting here because there is no certainty that I can get my project done. I may invest 3 years of my time going through planning and zoning only to be turned down at the end. And so you, New Canaan, you, Darien, you places are anti-development. You are not encouraging of development. You've made that very clear. And so therefore I'm going to take my investment dollars, elsewhere. So that's an example of the private sector responding to friction, uncertainty in the market. I say that because we had a developer who built 6 condominiums on Forest Street. Means nothing to you. But I said, how do you feel about that? You got a great price for your condos. And he said, doesn't matter how good a price I got, I wouldn't do it again. Why not? He said, too much uncertainty around the project. And I think that's really important for all of these 140 towns in Connecticut to realize that builders are taking their money to the next town when we make it too difficult for them.
Tony, that was one quick comment of in Connecticut, there really is no county governance. So it's each municipality is their own. And some municipalities are openly hostile to development. Others are actually more accommodating. And a place like Stamford and Norwalk tend to be a little bit more on the accommodating side. Bridgeport has a whole ton of issues on its own that are really too bad because Bridgeport is a huge opportunity, but they got to get out of their own way. Otherwise, it's not an opportunity. And, there's a friend, a very wealthy friend, and, he's investing in like Russian and Venezuelan real estate. And it's like, are you out of your mind? How can you possibly do that? And he goes, no, look, I understand the market. And when you look at the potential returns versus New York City, where like New York City has a 3 cap rate, and you're like, a 3 cap rate? I mean, what's the upside? How can this work? But it's kind of solid gold if you have it. However, of course, trying to develop it, you try to go through landmarks, and it's just you have years of understanding what happens and what can go on. So in some way, maybe Russia, Venezuela is a much better market with much safer returns, which is kind of crazy.
Did he mention what kind of returns he was getting?
I think he did mention a couple of things, but you're up into at least double digits. But his surety on it was much higher because he understood what he's doing, where he is. And the old classic, if you're buying at the bottom, it can go worse. They can actually take it all. And then who do you go to fight with? Right. But in New York City, if the city government says that you can't do something and basically steals your property without, essentially steals your property, you got 5, 6, 7, 10 years to fight it out in order to try to get it back. And, unless you're a real big developer with scale and all of that, you have a lot of risk there that again, that uncertainty is a huge risk because of the concentration of your resources.
Understood. So when talking about, cap rate and risk, what are some driving factors for that? As I'm, looking to buy a first building, I know we talked about inflation, regulation, some of those high level items, but specifically while attempting to underwrite a deal, what are some factors that I definitely should consider and must consider that most people don't?
I think one of the dangers inside of real estate for new investors is that there's a lot of existing investors and a lot of people who really know what they're doing in each market. Mm-hmm. And so however you can find things that are not full up listing. If there's already a listing out there and it's being put out to 25 or 30 people in the market, odds are that's going to trade at something around what the market value is. If you're able to go ahead and find some way to connect with somebody who is with an off-market transaction, and you're able to bring value to that deal, then you have a much better opportunity. But just being a retail buyer, I mean, there's a lot of money chasing a lot of deals, and if it's a good deal, somebody's probably going to take it on the market. And they can probably take lower returns than you would. But if you're able to actually, again, search stuff out, find the seller, know how you can end up making the stuff work together, have a good idea about how you can add the value to something, and possibly getting some sort of an assemblage and making 1 + 1 + 1 equal something more than 3, that's where you can probably add the value. But if it's a plain vanilla office space or, class A retail or something like that, it's going to trade at market, and that'll probably be it. That's my opinion. Sorry.
So Scott and I have a mutual fund who's a genius at this kind of thing, Chuck Berman, and he sits on the housing board with Scott. And I asked him this question once. I said, I have a nice little building here in Connecticut. I'm thinking of selling it. It doesn't produce that much money. It doesn't produce a great cap rate. Let's say it produces a 5% cap rate, a 5% return. And I said, explain to me why these big lists I get through the email, I could buy a Walgreens or a CVS or a Chick-fil-A with a triple net lease, a 20-year lease in place and a triple net, and I can get that with a 10 cap, a 10% return and a triple net. I said, what am I missing here? And I think there's a great case study for you. And he said, well, what happens at the end of the 20 years? And I said, well, I just renew the lease with the Walgreens. And he said, be careful, because he said, not all real estate is like the real estate in your neighborhood, which has been around for 100 years. He says some of these traffic patterns change, and that shiny new Walgreens that just went up today with a 20-year lease could be worth nothing at the end of the lease. It's a 20-year-old building, it's tired, and it's no longer within the appropriate traffic patterns. And he said, so you can find your principal has decreased. Not all real estate appreciates, not all capital appreciates over the life of the lease.
There's actually some of our smartest real estate clients, because we work for people who have been very successful in real estate. It's stunning the level of deals they have under minority interest, where, I mean, it's like, okay, we'll take 6.4% of that building and we'll do 5.8% over here and we'll do 23 over here. And so they diversify their risk away from a single property, which is really hard to do on the smaller side. On the smaller side, you're better off concentrating your risk, but you're concentrating your risk and you got to make sure your baby works right. And the other part is the long term is a huge thing in the real estate. And just as John highlighted, everybody's thinking about, well, what do I do when the lease ends? Like, it's 12 years out, it's 15 years out. What does it matter? And they're like, no, that's important. And that's something I think to internalize as early as possible inside of your career is what's the end game? What's the exit strategy? How do I get out? And if you have a 20-year lease, how do you get out at 10 to 12 or 13 years? So somebody else will deal with that. And there's a sweet spot in there. Sometimes it's at 10, sometimes it's at 12, whatever. But how do you get out is a big thing to consider.
Was it interesting for Tony to actually go look for deals where he's actually finding deals and bringing bigger investors in, taking minority interests in 5 or 6 different properties as opposed to trying to buy one?
There's nothing better in the world than good partners, and there's nothing worse in the world than bad partners. So, if you have the good partners, and again, if you get a track record, you show that you can do it, you make money for your partners, you can then go ahead and people reward talent, and they will go ahead and reward, and you can become that minority interest and have pieces and stuff. Then eventually you can, it's possible you just buy it out and you do your own deals. But it's finding great partners is huge, and building that reputation as to an honest, hardworking, dedicated guy that's able to figure it out and add value is huge.
Tony, as one bit of advice, in a previous lifetime, I owned my own CPA firm and did a fair number of not LLCs, because it was before the day of LLCs. They were called LLPs. They were called limited liability partnerships. Okay. And I had a real estate partner. I wasn't in real estate. I ran an accounting practice. Okay. And we used to do deals together. He'd bring the real estate, I'd raise the money. Go make a lot of friends with a lot of accountants who have a lot of clients. They're the ones who will give you the invest. They were the ones who will get people to invest.
Hey, I love this idea. Wait, is it, can we all call you up?
Exactly.
I love this idea.
We did 9 deals in this city. Okay. And I raised half the money on 9 deals. Okay.
Wow.
I think Roberto might know this. He may not remember, but we co-op 360 Riverside Drive. Okay, we owned 3 buildings on West 45th Street and still own them between 9th and 10th Avenues. Okay, down in the village. All right. So go and make some friends with some accountants, and they will, and you just bring them the deals and you show them the numbers, and they will get their they will get their clients to invest in them.
Interesting. Thank you for that. Thank you.
Guys, I'm gonna have to jump. I got a meeting to run to. Thank you so very much, and I hope I didn't hog this too much. Scott, thank you for everything. And
Michael,
Roberto,
thank you
and
for your
Don, once
input.
again, you're amazing.
Great, Michael.
Michael, thank you so much.
And Tony, that's actually, I mean, Michael's point's really huge because everyone out here, I mean, if you have money in the bank right now, the bank pays you 0.1, maybe, if you're lucky. And, you know, going to the market, it's like, boy, you got a lot of stuff out there that who knows what's going to go up, down, whatever. And if you're able to create a bond, even if it's a 10-year payment stream or something that returns even 7, 8, 9, 10%, that's attractive to a lot of people for money that they have on the sidelines.
Interesting. Thank you.
So what you're saying, Scott, is that the finding the money is easy if you've got a good idea. Now, if you've got a good idea with a good business plan behind it, if you have access to a great performing asset, money will follow it.
I would say that the whole thing comes down to the reputation. And so, I mean, if you can develop a track record and whatever you got to do to get those couple of, to get 1, to get 2, then everything after that starts falling into place. Those first ones are hard. And again, there's nothing easy in this world. And that's why, you show it, you prove it, you do the dedication, you make it happen. People reward talent. And so that's a huge part. But once you get a track record, their raising funds will become much less important. And the track record doesn't have to be huge. It just has to be, you show you've done it, and then there's a lot of sources.
Correct. Thank you.
So to my partner, do you want to take us out? Do you want to give us a little bit of a recap of your market report from your own words? Because I read your market report and I saw, interest rates and inventory. What did you say in your market report?
Basically,
what do I need to know?
I think that there's tremendous opportunity right now. I think the prices have not appreciated yet, but they are going to, just from a standpoint of, I think there's going to be tremendous demand. I think there's going to be more demand than there's supply. So the supply and demand curve just alone is going to push prices up. I also think that things are going to get more expensive later in the year as interest rates start to rise. I don't think that we have seen foreigners in really any form yet. I mean, some have leaked in, but I'm starting to get calls from foreigners who are slowly starting to come in and slowly starting to engage. Now, Kent said that, during times of, after times of instability in the economy or in the world, that America has always been the recipient of a tremendous amount of international investment. Now, that happened after the financial crisis. It happened after 9/11. And because America is essentially, it's transparent, it's stable, it's liquid. Yet during COVID, the one thing that hasn't been able to happen is the borders were shut. So they couldn't really come. So now as the borders open and COVID starts to hopefully clear, my question is, will there be a pent up demand of foreign purchasing that really infuses demand and really makes it difficult. So there's an opportunity right now to get in. I mean, I still think right now that inventory is just really lean. But hopefully in the next several weeks, as what is typically cyclical, that by the end of January, February, March, we're going to start to see a tremendous amount of property come on. And also, and then from a family perspective, you know, when those families, when it starts getting towards the end of the school year and people are looking to shift, they need to replace themselves to the Upper East Side or downtown, or the child is in school here or there, or whatever the case may be. There's going to be a lot of shifting of those family-sized apartments. It typically tends to happen starting April, May, June, so that they're settled by August. I think there's tremendous opportunity on both sides. If you're selling, you may want to sell before the interest rates start to really spike. At the same time, if you're a seller, you kind of want the demand to start rolling. Like, I don't see that momentum coming yet, but hopefully early February, March, it really starts to roll. And that, because, you know, someone gets out in the marketplace and they make an offer and they lose it to somebody. And then they're like, okay, I lost that. And then they see something else and they make an offer and they lose it to 2 or 3 or 4 people. Then they start to become more and more aggressive. That's the place that you want to be as a seller, because people are really putting their best foot forward to outbid somebody. And then you're bidding from a point of, you have leverage in your negotiation. The one mistake that sellers can make is to overprice, though, because it still is very price sensitive. If you overprice, they just don't come. They'll just let you sit there. That's my recap, essentially.
Good
Hey,
job,
here's
Roberto.
Greg.
Greg.
What's up?
Greg.
You know, I said I'd come troll and see what's going on. And, I want to point out too, if you don't mind, that I agree. The overpricing is the scariest thing that could derail this, because the buyers will leave. You know, they're going to be mad they missed the boat in terms of the cut rate prices. Rates are going up. If it gets pushed too hard too quickly, you're going to see things slow, halt actually in certain markets. I do think the benefit that we'll receive this year is the local economy will make more progress. Something that has been a headwind for us will switch and actually support us. And with Wall Street bonuses probably exceeding $35 billion, I think New York City should benefit between that, the return of the foreign buyer, the new mayor brings hope. And that's one thing you need during a pandemic is hope.
I get that we have plenty of money chasing too few and too little inventory. And I understand intuitively what that does to the high end of our market, which is what Roberto sells. But I know that as a guy who studies the unemployment numbers carefully, can you talk to me about the unemployment picture in New York now and how that's going to affect the rest of the market?
Well, the national unemployment rate just fell below 4%. So that's had an amazing comeback. New York's unemployment rate, we'll find out next week New York City, what it was for December. The number's not out yet, but in November it was 9%. So like a lot of large cities that were hit hard by the pandemic, it's going to lag. And, there's 2 aspects to it. One is to have hiring pick up again. And it's just going to take a while to undo that damage. But the other thing is getting the people back into the city working. You can tell by my fake background and my Yankee, pullover that I'm not in the office, right? So I think that it's those 2 things. We thought by now that about 2/3 of Manhattan office workers, and there's 1 million of them, would be back in their office. That number at last count was less than 30%. Right now, it's probably 5 to 10%. So that you need that to help support the city's economy, the restaurants, especially now when, even though the doors were more opened in November, Omicron has made it so, tourism again is going to take another step back. But obviously the jobs here do support the whole region. And I think it's, if we can continue to make progress, it'll help us going forward. But I don't think New York is going to see rates as low as 4%, unemployment rates that low for a while. It's just going to take that much time. But
But
with
New York will persevere despite relatively high unemployment.
yeah, I mean, look, New York City's unemployment rate is usually higher than the nation's, although it's interesting to point out right before COVID, it was lower. We had an incredible time of prosperity here, which actually hurt our market before COVID, because without a recession, prices don't adjust. We went, so long without a recession, sellers just became too emboldened, and Roberto knows this as well as anybody, the high end froze up for 2 years. So getting back to pre-COVID levels is not exciting for a lot of us. We want to get back to, pre-COVID levels when things, and the inventory, having a lot of inventory right when a recession hits you is a good thing, from a sense that prices adjust real quick. You get back to normal in terms of where prices should be relative to demand and economic conditions, and then they don't rise too fast. The problem, the rest of the country, like your markets out there, John, and Florida and Long Island, where I live in Westchester, is there was no inventory to begin with. People took a 2-3 month pause and then started buying homes again. And prices rose dramatically. They couldn't build new homes fast enough with lumber prices and shortages of materials. Having a lot of inventory is a good thing. When you come out of a recession, it forces sellers to face reality and gives buyers options. And I think as New York City continues to come back economically, that's really going to help us. The foreign buyers returning will really help us. The MTA getting $6 billion from the federal government will help us, because it's a mess. Hopefully.
But they have an $18 billion deficit, right?
You don't look at that. Look, we are almost $40 trillion as a nation. Anybody that keep anybody awake at night? It doesn't keep me awake. Nothing keeps me awake at night. I get tired very quickly. Roberto's hair still looks great. It's not worrying him.
I've got hair. That's all I'm worried about.
Well, I number mine so I can tell if I did just get a haircut recently. But
I don't know if you guys in New York know how broken the Connecticut market is right now. Last week in Darien, a house came on the market and had 89 showings over the first weekend and 24 offers. That is a market so far out of whack that
What price point?
It causes what?
What price point is that?
At that magic $1.5 million price point. The problem is that professionals like myself are losing confidence in our ability to price in a market that is so volatile. I can go in and price a house, and the next agent will say a number 10% lower, 15% lower, or 15% higher. It's happening all the time. And I'm proven wrong every day by a factor of 10%. Every day I'll price something. I'll price the $4 million house and find it sells on the first weekend for 4.5. And yet I have a $750,000 house on the market in New Canaan right now. It's the cheapest house in New Canaan. Why didn't that get 89 showings this weekend? 9 people came out from the city to see it. I'm not complaining, but you cannot predict. Why doesn't a $750,000 house get 89 showings? So it causes the market to be very unpredictable, and that's why I say broken. You have something like 47 listings in New Canaan. We are a town of 20,000 people and 7,000 households, and there are 47 single-family homes on the market right now. That's not enough for me to tell my sellers that I can look at you're competing with two houses, 3 houses, and give them an accurate assessment of what their competition is doing, because there's no competition.
What was your inventory like to 2018, 2019 at this time?
So if you look over the 20 years, it should be 250. But during the 2018, 2019, when the pendulum was on the other side, the market, we had 350. We peaked at 351 houses on the market in New Canaan at the end of May, when you're still waiting for a few to clear out through, they're ready to close. But 351 was the highest number, and we're at 47. So we've been watching for the last year or so. All 16 markets in Lower Fairfield County have been looking at a 40% decrease in inventory. Right now in New Canaan, if you want to buy a 3-bedroom condo, there are none available between $800,000 and $1.5 million. There is 0 available. Now, a couple months ago, there were 3, and you could at least then negotiate. Well, if I'm not going to overpay for yours, I'll go buy the other one. There are 0 available. So that means that of the 30 condos on the market now, which looks like normal, 6 of them are 1-bedroom under $600,000. And then you've got 30 of which I would say 24 of them are new construction at 1.8 million and above. So you have this great big, help me out here, Greg Heym, great big donut hole in the middle between $600,000 and $1.8 million, where I have 0 inventory of condominiums. And it makes no sense.
Well, as you said, it's a recipe for disaster is what it is in terms of how prices can get out of whack. It's like right after the financial crisis, trying to value mortgage-backed securities. When there is no market, you don't know what values are. And I think, again, therein lies our advantage. Inventory, the pure number of inventory levels in Manhattan right now are historically normal. This isn't 2014, 2015, when we might have 3,000 apartments for sale. There's 6,000 apartments for sale right now. That's not a lot by itself. Relative to demand, it's very tight. But we still are getting enough supply to do that. I think the problem is your market has been nonstop on fire for almost 2 years now. You know, where people were, you had a decent amount of inventory in the beginning. It got absorbed very quickly. With the Wall Street bonuses, that's going to help, your market even more, or maybe raise prices even more, however you want to look at it. And I think it's a problem, because one thing we all know about home building is that most areas build too much into the recession. The recession comes, they don't build anything, then they don't have enough when the recovery begins. Here, it's been a little different because, this was the shortest recession in US history, and builders tried to build, but they couldn't get the materials, couldn't get the labor, and that's still an ongoing issue. That will abate, but it's going to take time to get caught up. And I think it's very hard. The old expression, careful what you wish for, right? Sometimes you want more inventory, you get it, and then you can't sell it. But the forces of supply and demand will work out prices, but people may not like them. And it's tough, as the economy is expected to have pretty good growth again this year. And I think corporate profits, while not rising the way they did in 2021, will show growth this year as well, even with higher interest rates. The demand is still going to be there. It's just going to mean broadening their search areas, looking into different markets, coming to Manhattan, hopefully. Just kidding. I win no matter where they buy. But I think it's, they're going to have to adjust their expectations and move quickly. And better than me, John and Roberto, buyers don't like to feel like they have a gun to their head, and they have to pull the trigger on a transaction or they're going to lose. But they're learning that lesson in Manhattan. I keep hearing it every day from frustrated brokers who keep taking clients to see properties who they want to think about, and then they're gone.
Yeah.
I think this was a good show, despite the fact that we didn't get our guests, the guests we wanted. We got some guests, and we got a good conversation. So thank you all. And we'll try and get
Greg, thanks for popping in. Tony, good to see you.
Good to see you.
Thanks, guys.
Nice to meet you, Tony.
Captain.
Thank you, guys. Thank you.
All right, guys.